Hello, welcome to LCG's preview for the week ahead. This week I'll be discussing no-deal Brexit concerns, new Russian and Turkish sanctions, as well as record highs for the Russell 3000 index. Before that though, I'll run down some of the top corporate results to watch this week. So we have RWE, AG and Home Depot reporting second quarter earnings on Tuesday. Macy's, Sonos and Cisco report their Q2 numbers on Wednesday. CAS Minerals releases its half-year update, while Walmart, JCPenney and Nvidia report quarterly numbers on Thursday. Then we've got Deere & Co reporting their second quarter earnings on Friday. Moving on to the economic calendar, on Monday there is China foreign direct investment. On Tuesday, German CPI, UK unemployment and Eurozone GDP. On Wednesday, it's UK CPI, the Bank of England inflation hearings and US retail sales. On Thursday, there's Australian unemployment. And on Friday, we finish off with Eurozone CPI and Canadian CPI. So we still have this very real prospect of a no-deal Brexit, and it's clearly rattling markets. A noticeable development last week was, while we've had weakness in the pound against the dollar for a while now, it's pretty sustained downtrend in cable. What we saw last week was a breakout in the long-held trading range in euro sterling. So that's the euro pushing higher while the pound dropped in value. And if that technical breakout is anything to go by, then there's been a decided shift in sentiment towards bearishness, towards the pound. And it makes sense. We're heading into the summer. Very little that Theresa May can do to adjust the fact that not everyone's very happy with her Chequers deal. Although towards the end of last week, we did hear some positive noises from the EU that they may accept the UK inside a goods union, which is something they hadn't previously considered acceptable. So maybe there's a realization here on the EU side of things that actually things are getting a little bit desperate in the UK, and that a no deal prospect is getting really quite real. But for the time being, it looks like traders taking the opinion that the risks of holding sterling are a little bit too great at the moment, particularly in the light of that dovish Bank of England meeting the other day. Of course, we do have the inflation hearings coming up, so we'll have to see what the Bank of England have to say there. It's been a big week for not just tariffs, but also sanctions. Turkey hit with sanctions from the US, so the lira dropped again to new record lows. This has been an ongoing theme. The lira has been hitting fresh record lows all year. The currency's down around 30%. The market, the Turkish stock market's down around 40% this year. So obviously Turkish assets getting hit left and right. Not only is it getting hit by sanctions, but that's almost just rubbing salt in the wounds of the fact that we've got a very unstable president there who seems not so inclined towards democracy and not so inclined towards an independent central bank. So all those put together, we're looking at an ongoing period of weakness, and you're really trying to catch a falling knife if you're trying to catch the bottom in these assets, in these Turkish assets. No sign of a bottom just yet. Russia also again hit with fresh sanctions, this time the blame for the Skripal poisoning in the UK. That was the reason the US have set new sanctions into Russia based on a Chemical and Biological Weapons and Welfare Elimination Act. So all that put together is the first round that they've just implemented is quite similar to the sanctions they already had in place. The worry is more about the second round of sanctions that actually could do some serious damage to the Russian economy. Very different picture between Russia and Turkey when you look at the markets. Russian stocks have been pushing into record high levels, so this might be a reason for some investors, particularly overseas investors, to take profits if these sanctions actually do start to really bite. The other thing I wanted to mention was that US small cap stocks, so specifically denoted by the Russell 3000 index. Now that's not as popular as the Russell 2000, but as you guessed, it contains 3,000 shares, not 2,000. And it's a very broad measure of the US stock market, covers about 98% of US equities. it made a record high last week. So there's been a lot of talk about a very low breadth, i.e. there's just a handful of technology company shares that are driving all the gains in the US stock market. Well, the fact that the Russell 3000 has been hitting record highs, while in fact the Dow and the S&P 500 are close but have not, would suggest that actually the market breadth is quite decent. And this does make sense when you think about the general backdrop that we're dealing with here. It's the international firms that are getting hit with the tariffs, having to deal with the difficult political climate, etc. At home in the US, it's a very strong economy, so strong that the Fed is really the only one out there that's been able to pull off rate rises. So you've got a strong economic backdrop, and obviously the tax cuts, strong corporate tax cuts, which mean higher profits for these companies. So domestically focused smaller US firms, which make up the bulk of the Russell 3000 index, and indeed the 2000 is probably going to follow quite soon. In terms of this success, it seems like there's only upside from here. So we'll be watching those old record highs. If we can hold the gains above there, it speaks well to the broader US market. Thank you very much for watching. Good luck trading this week. And if you did want to see these videos as soon as they were released, please follow LCG on YouTube and social media.